All right, welcome everyone to our stock market weekly update. This is we've got a new time here, at least for a couple weeks, while Chris and I are on the road in Asia right now in Bali. But yeah, it's our stock market weekly update, September 16th, 2019, and there's some definitely some action in the markets right now. Last week, the markets were up about 1% in the U.S., about 2 to 3% in Asia. Europe was also about a percent and a half or so. Positive results there. And so, we're nearing all-time highs again. Although today it looks like, this morning futures are indicating maybe potentially, a little bit of a down day here. Let's look. See if we can get a little tighter chart here. But anyway, futures were gapping down. It looks like they've recovered a little bit. So it might be a negative day, might not. But there was some stuff happening over the weekend in the oil markets, geopolitical concerns there that may weigh on the markets this week. But overall, markets have rallied quite a bit in the last week or two. All that worry about recession risk that people were worried about in August seems to have abated somewhat in September. We're seeing, interest rates really moving back up in the U.S. You can see that here in this chart. You can see that, the 10-year, for instance, has rallied from about bottom of about 1.4% to almost 1.9%, which is a big move in the interest rate markets. So, with some positive economic data that we got in the last couple of weeks, along with, some positive outlook on the trade war front, and, investors, I guess, just getting a little bit less concerned about certain things. We had a pretty big rally in stocks and in interest rates. So interesting times. Again, I think this is not that unexpected. I think, we can still chop around, and it's a very mixed economic picture still. So really any like small readings in either direction can send us up or down a couple percentage points. So yeah, I'm not calling a strong bull market run here, but it is interesting to see some positivity return to the equity markets and oil markets. Obviously, that's a big piece of news this week. Over the weekend, we had Saudi Arabia had some attacks on key oil infrastructure, and so crude oil is up about 10% right now, and that's a pretty big move for crude. For a one-day move. So there's now the U.S. has said, Trump has said, he tweeted out earlier today that the U.S. would potentially release some reserves from the U.S.'s Strategic Petroleum Reserve to help with any global oil shortages in the short term. Nonetheless, oil's still up 10%. And it's likely that even though the Saudis have said they can restore production within a couple days, it is likely that there's probably going to be some longer-term impacts or medium-term impacts, I should say, for the oil markets with some of the Saudi infrastructure being affected. And additionally, you've got just increased geopolitical issues because the U.S. has indicated they believe Iran is behind a lot of the drone technology that was used by the Yemeni rebels to attack the facilities. And so, you've got heightened tensions there in the Middle East, and that's always concern because, that could lead to further supply being taken out if there's strikes on Iranian assets or, potentially more strikes on Saudi. So, it's an interesting time. And we had oil last week was actually down until this news over the weekend. So, oil markets have been pretty volatile, but overall they're doing well for the year. Oil markets are up about 30% year to date now. So we've called out, or I've called out, the weakness in oil stocks and the energy sector in general. It has been rallying over the past week or two, but we're seeing a big rally as well today. And a couple of our names on our watch list, like Encana and Devon Energy, are how I've been looking to play this. There's a lot of different ways to play positivity on, or at least a turnaround in energy markets. But, Encana seeing some nice, some nice movement here with, it's still pretty far off of where it was even a year or two ago. But we were bottoming out here in kind of the $4 range, and we're probably going to push up over $5 easily today. I think it's indicating it's going to open the day at around $5.20 a share. So about a 25% move from the bottom. Hopefully that continues. I think this is probably a at least a $6, $8 stock, potentially, double-digit stock again if oil prices remain above $60 a barrel. So, it's definitely positive for our position here, and definitely supports our decision to buy more as the stock went to really, really low levels. So that's interesting to see what's happening in oil markets, and we'll be monitoring what's happening there over the next couple of days. But definitely a shift here near term in the markets, like I said, with equities rallying. And you had the ECB last week cut interest rates, and they restarted quantitative easing. So that's obviously very supportive for markets. Now, the U.S. has a pretty key interest rate decision this week. That's really the big macro data thing that we're going to be watching this week. On Wednesday, the Fed interest rate decision will be given out. It's still an expectation that it's a 25 basis point cut. Now, Trump has been tweeting and criticizing the U.S. central bank again over the weekend. With the ECB cutting rates and implementing QE again, Trump is, he's just saying that basically the U.S. Fed is not being as aggressive as other countries, and so he's upset, and he thinks that they should be cutting rates to zero or even lower. Of course, that's just really to help his own self, but nonetheless, it's interesting to see that tension still there between Trump and the central bank. So expectations of a 25 basis point cut. If it's different than that, I think the market's going to react very violently. If we get either a 50 basis points cut, which is pretty unexpected, but if we did get that, there'd be a pretty big rally in markets. If we get no interest rate cut, there's probably going to be a pretty sharp sell-off too. So again, I don't think the Fed's going to step too far out of what's expected given what they've said over the last month, but it's interesting to know that this tension still exists between Trump and the central bank, and there could be some implications of that longer term. But anyway, the other thing that is supporting markets besides these interest rate cuts is that Trump was actually talking about a potential middle class tax cut coming next year in 2020. His administration apparently is working on some plan for a new tax cut there, and that would be supportive of markets as well. And then on the macro front, we had last week a couple of not like super strong macro data points, but definitely a few data points that were supportive. Like there was a pretty strong August retail sales number, although most of that strength was driven by the automotive sector. So that was one thing that was supporting markets last week. And then there was a slightly higher than expected August inflation number, which I think actually complicates the picture for rate cuts going forward after this Fed meeting, because the Fed will probably not be cutting if inflation is above expectations. But in any case, that was essentially indicating that we're not facing any kind of like massive deflationary threats currently, which would, be the case if we're going into deep recession. So inflation data looked pretty decent. The Michigan consumer sentiment data, which I don't put a whole lot of stock into, but it showed some slight improvement month over month. And then weekly jobless claims were pretty low last week as well. So again, these were just, at least for as far as U.S. data points are concerned, pretty supportive of higher equity markets. One thing I want to point out on the macro front too, while I'm talking about it, is that, if we look at yield curves, the U.S. has obviously still got pretty positive yields. Actually, let's pull up global yields here on Koyfin. So let me add a few here. If we look at the German 10-year versus the U.S. 10-year, German 10-year is still in negative interest rate territory at about negative 45 basis points, while the U.S. is, at about 1.9%. So pretty big difference there. Even if we look at countries like Italy, which used to be a lot more very high interest rates on the 10-year in Italy going back, just 5 years ago, Italy is hitting a new low in terms of its interest rate. So it's a weird mixed picture here on the interest rate front where, like in Europe, we have low to negative rates, and in the U.S. we have still pretty I wouldn't say high rates, but nicely positive rates on government bonds. And so I could see a scenario where if the economic picture looks pretty decent and we're not tipping into deep recession, I could see more money flowing into U.S. markets and supporting higher valuations in stock markets, because what may happen is these, banks that we've talked about that are facing negative rates are not going to invest in government bonds at negative rates if they can go invest assets in the U.S. and earn positive return. So we could see this differential between U.S. rates, which are nicely positive, and European negative rates, we could see that differential close a little bit. And part of that would be higher equity prices and potentially higher bond prices as well. So it's just something I'm watching. It's not necessarily a great prediction I'm making, but I'm just pointing out that, equity valuations are still pretty reasonable in the U.S. And if we're not tipping in a recession, equity valuations could go quite a bit higher just from the fact that there are all these foreign investors who may be looking to get positive yield in U.S. markets. So just something to keep in mind there if you're, bearish on markets. It's why I'm not like hugely net short the market. I have a pretty decent cash position, like I said, to take care of opportunities, take advantage of opportunities. And I am short a small amount of S&P futures that I put on, a couple of months ago that I talked about in the channel. But it's only a very small hedge. So that's why, again, I don't tend to put on massive market shorts, at least not, in this type of environment. But in any case, just kind of still, again, in a weird mixed macro picture. And it's hard to really make sense directionally of where we're headed over the next 12 to 18 months. I think chopping around is as likely as anything, really. But in terms of, specific stocks, in terms of position changes last week, I didn't have any position changes. Now, Nikki entered into a swing trade on a company called Domo, ticker symbol DOMO. It's a US-based company out of Utah, and they do enterprise software. They focus on business intelligence and, data visualization software. So you can think of their competitors like Tableau or Looker, MicroStrategy. There's quite a few players in that space. Even Microsoft with Power BI and Amazon with QuickSight have their own tools for that as well. But in any case, Domo went public, I think about 2 years ago now, and the stock has had a pretty wild ride. I actually wrote about this stock in my most recent newsletter post, which you can find at stockgeek.substack.com. I'm going to try to start updating this a little bit more. But yeah, I talked about Domo in this post here, so you can read a little bit about it. But in any case, Domo has had an interesting ride as a stock because it went from $16 last fall, up over $40 in the spring of this year, and then now it's all the way back down to $16 again, about $17 today. But this company reported earnings last week, and so it was a disappointing report for some investors who had been holding the stock. But in any case, it trades at quite a big discount in terms of valuation to its enterprise software sector. If we look at, a lot of people are using price to revenue or price to sales metrics to value SaaS companies these days. And if we look at like enterprise value to sales, you can actually see that here in Koyfin right here. But it trades for less than 3 times enterprise value to sales. And, there are lots of other SaaS names that we can look at. I can't remember if I have this dashboard up in Koyfin. But yeah, I have at least a few SaaS stocks here. And you can see, like, if we look at EV to sales for these other SaaS stocks, there's some that are up almost close to 20. They had been trading over 20 a few weeks ago, but a lot of them in double digits, a lot of them, most of them above like 5x in most cases. Again, so Domo at 2.7 enterprise value to sales ratio is near the bottom of this list. And that means basically that the market is giving it a much lower value on its level of sales than a lot of these other software companies. And so why would that be? Well, Domo is still growing revenue, but it's definitely seeing some deceleration in its revenue growth. If we look at quarterly revenue growth, you can see they did about 21.6% revenue growth in the most recent quarter. And that was down from 27.7% in the prior quarter and over 30% last year when they were growing. Now, deceleration in revenue growth typically happens to most companies that are growing really, really quickly. It's just law of large numbers. You're eventually going to see slowing growth rates. Over 20% growth rate is still pretty healthy. So, Nikki got interested. This is a low float stock. It's a low market cap, low float, trading with a pretty cheap valuation relative to its sector. Still growing over 20%. Good gross margins. And so, investors are concerned about the decelerating growth rates. Investors may also be concerned here about the cash burn. If we look at the cash flow statement, Domo is not profitable yet. You can see that. Let's look on a trailing 12-month basis. We can see that, let's look at cash flow from operations. On the net income line, they lost about $130 million in the last 12 months. Cash flow from operations, though, is about, a burn rate of about $100 million over the last 12 months. And actually, when we subtract the CapEx, it's about $110 million over the last 12 months of cash burn. And when we look at the balance sheet, they only have today, when you look at cash and short-term investments, about $134 million of cash and short-term investments. So, with them burning cash pretty rapidly, they could be running out of cash potentially in, next year or two. However, I will say that if we look at the income statement, they are improving the burn rate. If we look on the quarterly income statement, you can see each quarter it seems to be getting a little bit better in terms of cash flow from operations. They were burning, 4 quarters ago about 30 to 36 million negative cash flow from operations, and they only had negative 18.7 million of cash flow from operations this past quarter, and only about 1.7 million of capex. So call it 20 million of cash burn in the last quarter. Again, Nikki took a swing trade because she saw some technicals I think that were pretty interesting, as well as the fact that, again, it's a pretty beaten up stock. It has a pretty big discount to its sector peers. It's got a low float and high short interest. So that was her rationale. And my concern, again, has always been kind of the financial picture and are they going to run out of cash? So I actually put together this quick little forecast model, just looking at even if they can improve cash burn quarter by quarter, are they going to be able to improve it fast enough to avoid a situation where they run out of cash on the balance sheet? And at least judging by these set of assumptions, I think that they could run into a problem sometime in early to mid 2021. So I'm assuming that revenue growth is about 20% for the next 2 quarters, and then decelerating to a mid-teens growth rate by the end of 2020, kind of early 2021. Now, hopefully that's where I'm wrong, and maybe Domo can actually put up a higher than expected revenue growth rate. Maybe they can actually re-accelerate revenue growth rate. That would be pretty key for them. But assuming they don't, assuming that the revenue continues to decelerate in terms of growth rate, and then making kind of gross margin assumptions that take their gross margins for the last 4 quarters and essentially keeping those constant, and keeping a relatively constant level of expenses like sales and marketing and R&D and G&A, just a little bit of growth in those. We get our negative, or we get our adjusted EBITDA number, which looks still pretty negative for the next 8 to 10 quarters. And then we got to subtract interest expense on their debt, and then capital expenditure requirements as well. That gets us to our free cash flow number, which is negative. You can see it's getting better. It's getting better quarter by quarter for the most part, getting to a negative 16, negative 17 million free cash flow number. But that's still negative, and it's not improving fast enough to get them out of the hole of the burning cash. So I forecast that they're going to have a problem sometime in 2021. Now, on their conference call, Domo management has actually said that they believe that they can get to profitability before cash runs out, and that they can self-fund themselves without having to raise more equity. So they believe, obviously, that my assumptions are wrong in some sense. So I'd be curious to actually drill down and understand what they believe they can do that the market doesn't and that I don't, because, when it looks like, at least from these assumptions, they're going to have a problem, right? So that's kind of an interesting gap between my expectations and what they're saying. And also, when we look at insider transactions on Domo, the CEO bought $2 million or $1 million worth of stock last week. And so that was another thing actually that got Nikki interested in the stock. it gets me interested too when I see that kind of a buy. So the CEO is putting some faith in their ability to get to cash flow break even before cash runs out. So, I'll have to re-examine these assumptions, but as of now, like I don't see any evidence that revenue growth is not going to continue to decelerate. So yeah, that's kind of where I'm at. Like, I don't know that I would be in this for a long-term today necessarily, but again, on a swing trade basis, like Nikki's talking about, this could be interesting because it is beaten up and it does trade at such a discount to the software sector. And if the software sector gets hot again, then this could be, one that really sees a nice pop. So it's interesting to look at this kind of two different ways, from the technicals perspective and from the fundamentals perspective. So anyway, that was the kind of the one trade last week there with Nikki. And I didn't have any major position changes. I'm definitely watching some moves in some of the stocks on our watch list, and some of the stocks that I own that I've alerted on. Like for instance, CTT. I had talked about how I had actually met with the CEO 2 weeks ago, and thought there were some really interesting takeaways there. But the stock has been rallying a lot in the last couple of weeks. It's up from where it was trading, I think, around 180. It's now up to about 220. It's good to see some positive movement there. Now we're above our average cost, which is always nice to see. So had some nice time to really initiate that position and make it a little bigger. And now it's moving in the right direction. The board members continue to buy stock in the company, so that's always a good sign. And just kind of watching to see what happens there. It's definitely making a move here, it seems. And then I noticed finally some we've had quite a bit of the stocks on our watch list see some pops in the last couple of weeks because beaten down sectors of the market, like I said, have been really rallying. And Macerich was finally getting some love last week. Was up about 10%. Looks like it might be moderating a little bit, but this is actually now, I think, a little bit above my average cost. But I think we started buying around this level, or I started buying around this level initially. So still a pretty good price on this company. But anyway, that's definitely one I'm keeping an eye on. One on our watch list that actually went the other direction last week was Mastercraft. So this is one of the largest boat manufacturers in North America. The stock had been rallying, like I said, because it was one of those beaten up stocks in one of the beaten up sectors. And it was rallying a lot, went from 14 to 18 bucks in the matter of I think 2 weeks. And then it reported earnings and it was down 20% last week. So the market didn't really like the earnings report from Mastercraft. Essentially what happened was they gave an outlook for next year that assumes that sales will be down low single digit percentage and that earnings will be down a high single digit percentage, because they're seeing weakness with some of their dealers that buy boats from them. And I think that makes sense because dealers are essentially worried about the macro economy and worried about geopolitical stuff. And they're seeing things like RV sales, which are down 20%. And so they're not ordering as many boats for next season as they did this year. And so Mastercraft is expecting a sales decline next year. Now, a low single digit percentage sales decline would not be Armageddon for Mastercraft. And the stock, if we look at a 1 year chart, for instance, has already been pricing in a pretty strong recession for Mastercraft. It went from mid 30s, got cut in half in the past year. So it's sort of like, well, I think, is this already baked in? But in any case, the market sent the stock down 20% regardless. They have an investor day this week. So that's one good I'm going to be keeping an eye on, just because of the big moves in the stock over the last couple of weeks and because of the investor day where we might get some new information on it. So Mastercraft is definitely one I'm keeping an eye on. It looks pretty cheap at these levels, even if you expect earnings to be down like 10% next year. Let's just take a look here. Let's try that again. I'll pull up the financials here. So, on a trailing 12-month basis, they have done, and I'll have to go and look at if there's any adjustments that need to be made. But I think, and there might have been a charge. I think there was a charge, a non-cash or a weird accounting charge that they did in this past quarter. So assuming that net income is more like 40 or 45 million on an ongoing basis. And that gets cut down by 10% next year. We'd be, looking at roughly about a 40 million in net income versus 45. And today the market cap's at about 280 million. So you're talking about 7 times, next year's earnings, which is a very cheap multiple. So even with a decline in earnings, now I guess investors might be worried that we're headed for multiple years of earnings declines. So that would be a different story. But again, I think this is a pretty cheap stock if you believe that the economic environment isn't going to just completely fall off a cliff for the next 3 years. So it's interesting. But yeah, I'm gonna dig into the Investor Day stuff this week on Mastercraft. It's definitely, I think, going to be one where I'm going to spend some time. So that's another one I'm watching. A couple other things happening this week. On the macro data front, like I said, Fed interest rate and the Bank of England interest rate decisions. There are only a couple earnings reports. There's Adobe, Chewy, FedEx, Darden Restaurants. Those are really the only ones of note. No one really from our watch lists. There's a couple of IPOs in the pipeline. A company called Datadog, which is actually a really highly anticipated one. They do, another one in this software data space, and Datadog is a pretty highly anticipated one. And then the WeWork and Peloton IPOs are still moving forward as well. So those IPOs could happen in the next couple of weeks. So the IPO market, again, showing some health, and that will be interesting to watch. Love to have some more, fast growing companies come public. But so that's it on the IPO front. And then other stocks that I'm eyeing, from the watch list, one that's been a little bit weaker is Square. It's now below $60. It's trading for about 57 a share. This was almost a $100 stock, a year ago, and it's come in a lot. It's still not cheap in terms of valuation metrics today, but it's growing really, really fast, so it can grow into its metrics pretty quickly. And it's been weak along with the other SaaS and tech stocks, so it's been under some pressure. So it's one I'm watching. I know there is some intensifying competition in some of their businesses, so that is maybe one reason why the stock is down as well. But I think at some point, I think this is going to be an interesting one to take a longer term position in because of its many avenues for growth. They just launched in Australia last week, which was a cool announcement. I think there's just so much more opportunity internationally for them to offer their Square terminals and Square payment processing solutions to small and medium businesses in lots of other countries outside the U.S. So it's definitely one I'm potentially going to look at for a longer term play. Keeping an eye on that one. Keeping an eye on the energy names like I talked about. Keeping an eye on Domo, CTT. Dropbox has been slowly making its way back. So that one's got a little bit of momentum. It's nice to see that. I was kind of perplexed by the sell-off that happened right after their last earnings report. But it was an opportunity to buy more stock, and so that was great. And now it's been moving up a little bit. So keeping an eye on that to see if anything funky happens there. What else? There's a Zillow Group from the watch list is another one that's been a little bit weak. So continuing to keep an eye on that one. Let's look at a 1-year chart here. You can see, it's starting to near its closer to its, annual lows now. If it dips below 30, it's still a pretty highly valued company for what it's producing in terms of cash flow and earnings today. And really the future of the company still rests on this iBuying segment that they've started, which I've talked about before, but it's potentially a huge opportunity for them to become a player in buying and selling homes, but there's a lot of execution risk. So right now it doesn't look like they're doing super, super well. They're doing lots of transactions, but the transactions haven't been very profitable yet. So that's been the knock on what they're doing so far. And it's a competitive space. You've got quite a few large, well-funded competitors, including Redfin, Opendoor, and a couple others. So there's some skepticism around that future business transformation. But if it gets to a certain price, I think I'm going to be interested, similar to Square, in initiating at least a small position for a long-term play. Not quite there yet, but definitely going to keep watching to see if it keeps weakening. So that's definitely one I'm looking at. What else? I've been taking a look at a couple stocks. There's favorite hedge fund of mine is buying some stock in a company called Sunrun, which is the largest installer of residential solar in the U.S. Tiger Global is the hedge fund. One of my favorite hedge funds to follow. Very, very smart, very good track record. And they've been buying this stock hand over fist. I think it's now their sixth or seventh largest position. You can see, maybe not. Maybe it's like a top 10 or 12 position for them now, but it's one of the stocks they've been buying a lot of lately. They're actually been filing as an insider on that because they own a pretty significant portion of the company now. So it's one that I'm starting to dig into a little bit. You can see all the Tiger Global purchases here, pretty much buying like, $6 or $7 million worth of stock almost every day in late August and early September. So they love this stock. They clearly see the potential for this to be a long-term winner. You can see it was up at like $20 a share earlier this year and sold off back down to like 15, which is where Tiger's been buying it. But obviously a longer-term play on the solar sector and alternative energy. And they're just, they execute well in what they're doing with the business. SunPower is another one in this space. SunPower has always had really great technology. They manufacture solar panels, and they also do installations just like Sunrun. But Sunrun's the number one player in residential solar. And they do a really good job. Solar City, which Tesla bought a couple years ago, has been run into the ground, which is why Sunrun has now become the number one player. And they know how to execute, and they have an interesting model where they make the cost essentially $0 up front for anyone who installs, or for most people who install solar. And so they pay to install the system, and then the homeowner pays a small amount per month to Sunrun. And so, yeah, it's an interesting model. And as solar expands in more and more places, the volume of this business can continue to go higher and higher, and they're in a pretty strong competitive position. So that's Sunrun. There's still some more work I need to do on this stock, but it's definitely one that it's got my interest with Tiger, buying it so aggressively. And, they have like these long-term contracts with their residential customers. So the revenue is, well contracted for 20, 30 years at a time. So they have this, revenue base and profit base for Sunrun is not going to be very volatile. It's a stock that actually could, be fine in a recession. They wouldn't grow during a recession, but they would, be able to continue receiving, steady revenue and net income. I think it's something like $10 or $12 a share in contracted value with their current customers. I think that's one of the things that Tiger sees in the stock, is that you're actually only paying a small fraction for the future value creation here, because a lot of the value in the stock is already made up with revenue and profit from current customers. So that's kind of an interesting one. But again, I need to do some more work, and it's definitely one that could be interesting. And alternative energy has these moments too, where it can really get momentum because it's a theme that certain funds want to invest in. There are funds that are dedicated to sustainability and socially conscious investing. And this is the kind of stock that a lot of those funds just blindly buy. So the other thing is that there are states like California, which are now like not only offering incentives, but mandating certain things like the installation of solar panels on every new home built starting in 2020. So that could drive solar install volumes a lot higher. And when you're the number one player, that's obviously going to help your growth rate. So that's one I'm digging into. One of our community members had asked me to look at a stock called GreenSky, GSKY. And this is an interesting one because this is a really beat up stock. Has had some bad news events that it has sold off on. But the reason that I'm bringing this up, I haven't done nearly enough work to make a strong enough opinion on this one. But I just want to give you a little bit of insight into kind of how I look at something. So one of the first things I do when, I look at a new idea that I don't really know anything about, one of the first things I do is just look at their, the last balance sheet, the last income statement, to see if there's anything funky going on. And just to get a sense, is there a lot of like net debt? Is there like a big net cash position? And here you can see like there's some things that don't always show up on a typical balance sheet. Finance charge reversal liability, tax receivable agreement liability. Those were two things that popped out right away. And so those are things I have to like dig into. And so it's that kind of stuff that like when I'm looking at a new idea, I make a note to, okay, I need to do more work and follow up on this because this is something funky. So GreenSky is one that like I haven't dug into enough, and I know there's some things that right off the bat I'm gonna have to spend some time understanding. And in addition to what's going on with current news events that sent the stock down, I have to figure out, are these permanent impairment type of events, or are they buying opportunity type of events? So really what I'm just trying to point out here with GreenSky is just that this is the kind of company where it wouldn't just be an easy, couple hours of looking at it and determining whether or not it's a buy or sell. Probably gonna have to dig in pretty deep and figure out what some of these more complicated financial lines and their financial statements, what the causes are, if the accounting representation is actually representing the true economic picture of what these things represent in terms of liability. Because you can see these liabilities have been growing. If you look at the balances on December 2018 versus the balances at June 30th, 2019, these liabilities have been growing. So that's a concern. Sorry, this line here, 164 versus 138, and then 303 versus 260. So that's a concern. The other thing that was pointed out was if we actually scroll down to the section called the management's discussion and analysis of operations, MD&A as it's sometimes shortened to. This is where they talk about the reasons behind revenue increases or decreases, and profit increases or decreases in the quarter. We actually see that there's some other things that we need to follow up on that are happening. And let's just find it here. So they're seeing a big increase in costs. There's something called this fair value change in FCR liability. So that's I don't even know what that is. That's like a weird thing that you don't usually see. So that's 38 million this past quarter versus 19 million in the same quarter last year. Through the first 6 months of their reporting year, it's 77 million versus 40 million last year. So something funky is happening here. I actually read a little bit about it before this update, and it has something to do with some relationships they have with their banks, who are assuming some of the credit risk of some of the transactions they're doing. And apparently the losses that their bank partners are experiencing are causing there to be charges against profit for GreenSky. And so that's not great. That means like, there could be lurking issues here that create overhangs for profitability for GreenSky. So these are all things that need to be dug into before I can really make a determination if GreenSky stock is worth buying or not. But that's definitely one. But it's an interesting company because their payments business and were previously quite a profitable business. We're talking about like 40 to 45% operating profit margins. And so this is definitely a business that looks like it might be a good business if there's not credit problems. So one that and with the stock down so much, again, it's one that needs to be looked at. So in any case, that's pretty much all I have for today. I know hit a lot of different themes and especially on the macro front, but there's just a lot going on in the markets right now. So if there's anything else specific, hit me in the Q&A. Happy to take questions. Yeah, I don't think we have any Q&A at the moment. I know it's a little lighter crowd today since we changed the time of our market update here to 9 a.m. Eastern Monday morning. Probably pretty hard for some people, but if you have questions, if you watch this on a recorded version, you have questions, hit me up in the channel. And we're gonna have this new time for a couple of weeks while I'm traveling in Asia, but we'll get back to a time that works for most everyone here in a few weeks. So no worries on that. But looks like we might have one question here. Someone raised their hand. Oh, maybe not. Well, why don't y'all just hit me in the channel if you still got questions, and I will see y'all there. Take care, everyone.